Okay, so let's start with this exercise. The whole objective of this exercise is to liken the investing process to driving a car. Okay, so there is a rear view, a rear view mirror, your past data. There is a current dashboard. So all this is your past data. There is a current dashboard, which is your current situation. Usually, when you think about planning investing in an unplanned way, you tend to look at just your current situation. You don't look at the trajectory of most of your, financial data. And most important, you don't look at the future. So you get a lot of numbers wrong.
Okay.
So that is the whole idea is to sensitize you and to create control checkpoints, which discipline your thinking, especially when you are planning a derivative strategy. So the idea is that you shouldn't lose sight of your own future finances, your own potential finances. What kind of potential debt capacity do you have? So you won't panic at the wrong time if you, if there is a cash flow demand and things like that. Then we dovetail your finances into the finances of the company that you are, into the valuations of the company that you have bought. So you don't lose sight of the fact that I am actually going to get a 25% return in the long run in a company at the valuations that I have bought, and my cost of funds is actually only 5%. So, and so on and so forth. So the whole idea is that you get a three-dimensional understanding. You know your past, you know your present, you know your potential future, you know how to convert that into balance sheet and off balance sheet debt capacity. So this has implications even for the ULUP and the leveraged strategy that we follow. Then you don't lose sight of what kind of potential return you are chasing. So on the day of an excessive MTM, on the day of a panic, you tend to get obsessed with current reality rather than what you are actually, where you are headed. So this whole document, we will co-write it. All the lessons that we will learn together are captured here. Here. And we will make you write all these. And we will make you, we will only do half the exercise. You we are co-writing the document. You will do the rest of the stuff. Then you will play around with it and you'll start understanding all the ratios.
Okay. Yeah, I think once we understand the structure of this document, what to populate, then yeah.
Correct. So now let's start. What is your current income? Take any number. It doesn't even have to be accurate.
45.
45. Okay. What kind of growth rate are you expecting?
10%.
So we are expecting 45 to go to 49.5 and so on and so forth.
Yeah.
What kind of passive income do you have? Do you have any investment income?
No, sir.
Investment income?
There are mutual funds and stuff, but it is not a recurring income. So.
Okay. And bank interest and things like that?
No.
No.
The PF is there, but that doesn't count as a bank
interest. No. The income that is not subject to this plan document, you can leave out.
Yeah. Okay.
Taxes, I should take what, 15%?
30.
No, at the margin they are 30, but average taxes would be what?
Close to 20, sir.
20. Okay, so any debt and liabilities?
This is on an annual basis, right?
Yeah.
So Yeah, that the EMIs will account to 36, close to 7 lakhs.
And are they growing or are
No, it'll keep diminishing over a period of time. I think all will get closed in a span of 4 years.
4 years? So next year, what are you expecting?
Yeah, 5, 3 and 0 maybe.
Okay. Living expenses would be?
Yeah, let's keep it at 5.
Okay. So this is the savings pool that we are looking at. Okay. From this savings pool, it's quite obvious that you have a debt capacity, which should be at least 100 lakhs, which is 4 times your current income. And it gets paid, as you are seeing, it is self-liquidating. Okay, so you can set your own. So from here, you can start planning. Okay, any capex or housing loans or anything planned over the next few years?
No, sir, no, nothing.
So that's it. Then, okay, any current funding available from the banks which you've drawn, which would be things like that.
I mean, the bank EMIs, right? So
yeah, bank outstanding.
Bank outstanding is around 30 lakhs.
30, right? But your capacity, as you can see, is you can take a rough from a growing income. You can take a rough, 3-year target or sort of debt capacity that you can service very comfortably a loan of say 100, right?
Right.
Okay, so this is not money which has to actually be taken. Okay, this you can see is your target. This should be maximized. So it's very clear that you already have 70 here. If we take this as 100, your debt capacity is 100. So 70 lakhs, you can already you can give yourself that target. Okay, remember.
So this is from family, friends, and relatives.
Oh, this is everything. Banks we have put on top. Okay, and this is the document, you can keep expanding it. It's not just like we explained that tier 0 is the money in your. Okay. So tier 0, when I ask you normally to the layman, when I ask, okay, how much money do you have? He thinks of the money lying in his bank.
Right.
Okay, but that is not the money you have. You have money which is available from all your assets. You can remonetize your assets. You might have a house which against which you can take a loan. So you think of those things as debt capacity. Okay, you might have whatever, some business assets. You might be having equity in a mutual fund, which can be drawn. You might be having bank deposits. So you put all of them together and you'll get a very, very different number over here. So long term, the reason why we have highlighted this is in red is, this is your part of the business. This is what you should maximize. Theoretically, a doctor can get his patients to lend to him. A doctor in a small town is kind of like a god. Okay, he can get patients and business associates and neighbors and, actually the entire town. When I say that doctor is HDFC Bank, that's what I mean. That you have the goodwill to be borrowing this, and see, if your intention is never to borrow it. So what is the tension we are creating? We are going to maximize this number, but we are never going to implement the number.
Yeah, keep it on standby.
Yeah. So what we are, trying to focus on is to maximize the standby capital to infinity. Why can this not be 100 crores? What does it matter? It has to be multiplied by the probability that I will use it. If the probability that I will use it is 1%, then effectively it's not 100 crores that I'm borrowing. Effectively, I'm borrowing 1 crore.
Yeah.
Okay. So this becomes a very, very important part of the business. So what are we doing? We are basically corporatizing you. We are treating you like a corporate. Okay. Why give up debt capacity when you can make money on other people's money without taking their money? So we'll come to that.
Yeah.
Okay. So without taking that money, converts it to what? I am converting real physical debt to what we call virtual debt. See, down below we've got this virtual debt. So virtual debt is the invisible debt market that we are going to operate in, called derivatives. Okay.
Okay.
So we'll come to that. First, what are we trying to do? We are trying to do risk management on the virtual debt.
Okay.
Okay. So what is the best kind of debt? Against the virtual debt, I'm 100% covered by physical debt available to me. So at worst, in a COVID bottom, I am going to put myself to some discomfort by drawing in the physical debt that I normally don't want to take. Okay. But I will be monitoring the cost of capital on that. What is cost of capital? Cost of capital conceptually is your anticipated return. The capital, the cost of the capital that is debited to the investing operation. So just think of yourself as, having a subsidiary called Anil Investing Limited. That subsidiary is independent from you. And you are pricing capital to the investing operation. That is what we are calling cost of capital. So it is not cost actually, it is your expected return. It is the standard, the bar that you are setting to the money that you have. Now, this cost of capital, there is a market cost of capital, not to be confused with the market cost of capital. Okay. And there is your cost of capital. The two are not the same. It's like inflation. The market will price cost of capital based on inflation and the equity risk premium and lots of theoretical stuff. Doesn't matter. Your cost of capital is a personal cost of capital. We might choose that for us, the cost of capital is the opportunity cost. If I am, keeping the money in a bank, then my cost of capital is just 6%. Now, if I'm getting more than that somewhere else, so I will move from fixed deposit to something else. So we'll come to all of this. We will name all these things and create a straitjacket for you that kind of limits your behavior and disciplines your behavior with a self-written document. You have yourself written this document and you are taking responsibility for this. I mean, we are taking responsibility. Your responsibility is to ensure that you do not misbehave at the wrong time in the market. And my responsibility is to make sure that the things that we say about a company are monitored and they actually happen.
Okay.
Okay, so this is where your company dovetails into the finances of UPL or Aurobindo Pharma or something like that. So the underlying expected return from a UPL is at a premium to the cost of funds to you from these places. Okay. So you have to monitor both the amount that you're putting in, the effective cost, we'll come to that, the effective cost of holding UPL, and you are now a bank. You're basically a bank and an insurance company. So the bank is the borrowing arm of the company and the insurance company is the investing arm of the company in the derivative.
Okay.
Okay. So you're now a corporate called Anil Investing Limited. Okay. In that corporate, this is the budget document. This is the financial planning document that you are making. These are your expectations. And as we go along, we will keep introducing, new things, if whatever you have, whether you have liabilities or you have assets and things like that. And in that period, we are going to learn new things. For example, when you make your balance sheet, you have to put in the total cost of ownership of your pink elephant. What is a pink elephant? A pink elephant is something that looks like an asset, but is actually a liability. A car, okay, an expensive lifestyle. Children,
Yeah.
children are actually liabilities, at least in the short run. Okay. So these kind of, so all your liability planning will be done over here. And we'll come to this net number, which is your capital, the capital we are working with. Okay. So we will calculate your actual debt. This we already know is 30 lakhs. So now we know your actual debt and we know your, at least your potential debt for a little while. Okay.
Yeah. So that capital is sum of funding?
No, capital
funding
is
banks.
the balancing figure.
Balancing figure.
If right now, let's say, do you have a house of your own?
Yeah. Yeah.
So what is the worth of that house?
150.
150. Now, against this 150, we just told you that you have only 70 lakhs of debt capacity. But that's not true. Against this 150, any bank will give you 100.
Okay.
Okay, so we can change this. So this is the number you have to maximize.
Okay.
And like I just repeating myself for emphasis so that you remember, this has to be multiplied by the probability that we will use it, which we have to minimize.
Okay.
So this kind of guarantees you that you are not going to take an excess of risk. This number is important only to find out, to measure the value at risk. The risk that we are taking on the asset book should not exceed your capability to write a check. Your capability to write a check is not just the money in your bank, but the money that you can get into the bank in the short run. Follow?
Okay.
Okay. So we are creating a tension. Your risk-taking ability is a function of your knowledge of the company. Okay. So it is not just the money you have, it has to be multiplied by the guts that you have.
Right.
Okay. So we will work at that confidence. And we will try to assure you that, your asset is going to earn 25, 30, 40% spread. And then we will try to maximize this difference, the VAR minus the cost of capital. Okay, so we will try to minimize this cost of capital. Suppose theoretically, I used to say in ITC that the cost of holding ITC is minus 4%. Why? Because I'm getting a 7% interest rate and my rollover cost is 3%. Okay.
Interest rate from the options book?
From the futures book, yeah.
Futures, okay.
Okay. So I'm getting 7% dividend yield and holding the futures book is costing me 3% or 4%. So my cost of holding is minus 3%.
Okay.
So we'll come to all that. So, from there, so all those, as we plug in all those numbers, you will start to understand A, your ability to take leverage, and B, the cost of the leverage. So your ability to take leverage has two costs. One, the interest cost, which is the rollover cost, and two, the volatility cost, which we are calling value at risk. So when your asset side goes up and down, you have to replace your debt with equity. So okay. I'm running ahead of myself right now. Let's come back to your financial planning document, to your balance sheet. So you learned how to fill up your income, your expenses, the savings cash flow. Already one milestone has been achieved. This savings cash flow, when you convert it into a flow, you start to understand what is the portfolio that you're actually managing. What are you comfortable with? Are you comfortable with the next 2 years, 3 years, 5 years, 10 years, 20 years? You just keep, filling that up.
Okay.
Inserting column. What portfolio do you want to manage? If you're young, you should be taking a longer tenure. If you're relatively older, you should be taking a shorter tenure, 3 to 5 years or whatever. So what number you are comfortable with, depends, remember, on your confidence in the asset. Okay, because remember, what is the assumption? The assumption is that the asset will not offer you any support in servicing this so-called debt. So you are going to service it with your own income. That is the conservative assumption. But slowly you start believing that no, my asset is also going to contribute. Then your risk appetite expands. So this is a document that, helps you over multiple cycles to increase your risk appetite with a very visible number. You know where it is coming from. You know.
I think that assumption must be factored into this calculation, right, sir? I mean, because
obviously, this is the time. One day I will ask you, what is your confidence that you will hold your job?
Yeah.
Okay, so we are.
That is one thing, and the other thing is this debt repayment will not be serviced by any of the equity or the F&O. That should also be factored into.
Conservative assumption. Okay, but if you know that we don't do too badly, most of our stocks do very well and all that, then we will, like in my case, I have no further income, but I can take 5 years and maybe even a 10-year horizon. Why? Because with 30 years experience, I know that it works. So I might have a different risk appetite from you.
Right.
Okay, but in your so this is the co-discovery of your actual, there's nothing I believe about you which you don't know. If I believe something about you, it's all there in the document. Okay, or if you have been given a target to move from, let's say you want to build up your income, you want to increase your passive income. So we will, put down that and give you a target. Maybe not rent, we'll say investment income. So we will take a target that this investment income should be equal to your business income within 2 years.
Right.
Okay, so then we'll put that down. And that goes towards your debt capacity. Okay, or we could say that your investment income should service your entire debt capacity. Should we use it? So all kinds of permutations and combinations are possible. Okay, but then instead of talking in the air where I am saying something and you are understanding only a limited part of it, this document kind of, it hardens things. There is no miscommunication anymore between what you are saying and then whatever we are learning, we are putting down over here. These are very important philosophical observations. So right now, this list is coming from my previous interactions with different people. Okay, and this is my agenda with you. These are the things where we must be of one mind. For example, MTM is not loss. Now, all accounting statements say that MTM is a loss. Income tax says MTM is a loss. Accounting rules say MTM is a loss. But we are saying MTM is not loss. Now, this is the question. Why are we saying that MTM is not loss? Because National Exchange says, sorry.
Basically, I mean, you advocate to stay long with the stock if we think that it is fundamentally strong, so that if you stay long, the MTM will automatically gets covered, right?
Because we are focused not on what the market is telling us, that the stock is worth 600 rupees. Okay, we are focused on this number. This is the number which we have to question. We are saying we are buying something which is worth 2,663 rupees. Now, 600 and today the market is at 600 rupees. Tomorrow the market is at 580 rupees. We are not bothered. We have to survive this. Because our valuation does not change. Do we believe that UPL will earn a target EBITDA of 25,000 crores? Do we believe that UPL will be worth 8 times EBITDA? Now, if you don't believe it, you can always reduce it. You convert this to some number, whatever. You take your horizon. What is the horizon? No, I don't want to hold it for 10 years. I want to hold it only for 3 years. You can change this number. You can change the valuation. No, I don't think.
But I think this strategy works only when you take delivery when the MTMs are high, right?
Correct. Yeah. So we'll come to all that. That's what I'm saying.
Okay.
This whole document is building up into that.
Okay.
Eventually, this document, your cash flow planning, will become a static document. It will not change every month. It will, once we've written it and developed it into a sophisticated document, we have what you are. Okay, but what UPL is changing on a quarterly basis.
Yeah.
Okay. In fact, as the stock prices changes and we have parameterized everything, we will be able to see with each change in stock price what the market is telling us. Okay, and the market can change in a week. So what are we doing? First, we are trying to harden what you are. That we are taking your income statement, your capex, your cash flow, your balance sheet, etc., etc. So we know which thing is where. Okay. Then this will not change too much. I mean, it will change once in a quarter or something like that. Then we have our policy document. These are the policies.
Yeah.
Okay. Why are we saying that MTM is not a loss? Because NSE believes that you are not going to turn up tomorrow. So MTM says, NSE says, Bhaiya, you have to put down the cash. But we are not leaving. And UPL is not closing down. So we know that we are not leaving, nor is UPL closing down. So you have to add the time value that you're going to get next month. You have to consider the revival in earnings of UPL. So for us, this is not loss, it is investment. This is what we are doing. This is when cash is needed. Otherwise, where is the cash needed?
Yeah.
Okay,
I mean, when the MTMs are huge, I think we'll need to fund both the MTMs as well as take the delivery, right?
So that's why, what are we focusing on? We are focusing on your standby cash.
Standby cash. Okay.
So your standby cash today, we are reaching, as we've reached a reasonable level of sophistication with the ULUPs. What are we doing? The actual cash that you're putting on the table is a very, very small part of the total cash that you want to put in. So what is it? It's cash flow investing. It's actually SIPing. What you're doing is designing a SIP. And how you design a SIP? When you get a very, very good opportunity, you are willing to even take a loan from the bank and I will pay off the bank. But here's the SIP because I've got the value I want. So you are not investing blindly. You are investing based on you're chasing a particular valuation and you have that valuation in a very disciplined fashion.
Okay.
And that discipline is my job. That is what I will be doing. We'll be adding to the fundamental understanding of the company.
Okay.
And that is the partnership between you and me. The liability side has to be maintained by you. Okay, which means the responsibility to not go bankrupt, to not run out of money is yours. So the cash management system belongs to you. And then we have a cost of capital, which is, the money, the returns that we are targeting. And we have what the market is giving us.
Okay.
So this is actually a summarization of the actual detailed discounted cash flow, which is a separate exercise where we are doing an analysis of UPL or Aurobindo or whatever.
Okay.
So those things we will dovetail that into your financial planning document. So whenever we are meeting, this will come with the, get dovetailed into the MIS.
Okay.
That this is what we want to do. This is where we are. These are the constraints under which we want to operate. So we don't want 100 crore rupee book. We will not go on the assumption that we will always be right. We are in fact going by the assumption that we will always be wrong.
Yeah.
And at the bottom, when the alligator has pushed us to the wall and is killing everybody else, that is the time we will take a painful decision, draw all that money and take delivery and go to sleep. So that is the risk management document that we are doing. For us, the derivative market is an information, provider. It is telling you
Okay.
when everybody is dying, when the alligator is accumulating the entire company. The assumption is that it is a good company. There's nothing wrong with the company. And, whatever the atmosphere in the market is overstated, or it is, a misleading atmosphere eco has been created. And that is the time when we are taking delivery. Exactly what you saw, what we did in Aurobindo Farm.
Okay.
Okay. So that's a
So at
different
that time, so post taking delivery, will we come out of the derivatives, or will we be
No,
staying
again,
with that as
that depends on our cash flow plan.
okay?
So if we are deciding to de-risk the portfolio, yes. If we are deciding to re-risk the portfolio, capital that was earlier not available is now available. So we are opening up new sources of capital. Right now, we haven't gone too deep into this. How you can expand and convert into multi-tier capital. The capital
Right.
itself that is available to the operation. Right now, you have taken no loan against your house. Okay. When UPL comes down to 3 times book value, you are willing to take a loan against your house.
Okay.
So you don't have to actually take the loan. You just take that loan, put it on standby, and we will duplicate the same book in the put book. Betting on the fact that UPL will not go to 500 now. Okay, so there will always be some news item saying that at 500 they'll be talking about 400. That's just the nature of the market. At 400 they'll be talking about 300. It's just the nature of the market. And the last time he will be wrong.
Right.
He will be wrong only once. Okay, but he is right 5 times. And he will be wrong the one time that you believe that he will be right.
Okay.
Okay, so the whole idea is to prime you up, to start believing that anything somebody says is always going to be right.
Okay. Okay.
Okay, so anyway, that is market behavior. We will discuss that in detail, and we do discuss it in detail. What is happening in the market is the regular stuff, but there is some control checkpoints which you must carry about your own capability. All the problems in F&O happen because people don't know their own capability, and they have taken on liabilities without reference to their own capabilities.
Okay.
Okay. So this is the document that becomes the standard. Now let us come to the asset side. How we can template every asset. This, of course, is a summary document. We have summarized the detailed discounted cash flow because that's irrelevant. We've converted, all the future forecasted cash flows into an EBITDA multiple.
Okay.
But come what may, we don't care. We just have to believe that UPL is a growing company with an unlimited runway ahead of it. Okay. And there's a particular growth for which I don't have to pay. Why? Because the current yield of the company, the current EBITDA of the company is enough to give me a return above my cost of capital. So I am not, whatever growth I get is free.
Okay.
Okay, so right now, what am I buying it at? At 612 rupees, I am getting a company at 45,000 crores. Okay, with an estimated EBITDA, whatever number you want to put in here, 11,000 crores. Okay, so we can keep discussing these numbers. And these are the numbers you got to change. Like I keep explaining that debt has to be assumed to be zero. And I've explained why.
Yeah.
Okay. So while the market is saying no, there is debt, we are disagreeing with the market and saying, okay, the accounting statements are saying debt, but this is not the debt that I consider to be risky. So within my investment horizon, the company will repay the entire debt. And therefore, I'm going to treat it like a debt-free company. In return, what do I get? I'm getting the company at 4 times EBITDA, depending on the reinvestment ratio and the operating cash flow conversion ratio, etc., etc. This is a satisfactory valuation for me. 100 divided by 4 is 25% expected return. The company is reinvesting my surpluses. I'm happy with it. Okay. So this is my projections for the company. What is my target? When do I want to, over my limited horizon, when do I want to reevaluate the company? So when the company has an EBITDA of 20,000 crores, the debt we are saying would have gone down to 0. The valuations would have changed from 4 to 7. The company will be worth 1,40,000, whatever number you want to take. And this will translate into this much rupees per share. Okay. From these valuations, we are going to start planning our own inventory. How many cash shares do you want to hold? Okay, what is the target net worth that I have? What is my current net worth? And what is the target net worth that I am? So this is my cash flow, my futures book. How much do I want to hold? What is the assumption of the rollover cost? What is my inventory, interest cost? What can I expect from my put book? You will put down your puts. So same thing like we did in the Aurobindo book, that there was a certain futures book where we earned intrinsic value. The rollover cost on the futures book was paid by the puts. Okay, so basically I ensured that the cost of my leverage was managed down to a 0 cost of holding, so that the 25% return embedded in the stock price goes straight to my bottom line with no cost of holding. So what are we managing in the derivative book? The cost of holding the operation. We are basically giving expression to an investment strategy through a trading strategy.
Okay.
So what we are really doing, and that is how we are reducing our risk, that this is an investment strategy. I'm not concerned with my profitability over 1 month, 2 months, or whatever. This is a long-term buy the business strategy where I have taken leverage, backed it up with my physical leverage, and then I am managing the cost of the leverage.
Okay.
Cost of the leverage has 2 elements. It has a rollover cost, which is an interest cost. It has a value at risk, which is the potential
MTMs
that I will face. How do I earn it back? By getting into the insurance business, where I am either writing puts or selling calls or doing whatever. So my trading activity is supposed to make a profit, which goes into my investing activity, and the long-term money, permanent money, which I must earn, must come from my investing strategy. Follow?
Yeah, I mean that strategy. Yeah. I think that strategy. I mean, it all depends on the probability and magnitude of the success, right?
Of the success. So you're buying somebody's business risk. You're buying the probability that agrochemical demand will grow, the agrochemical industry will double, India will gain higher market share from China. Within India, the export market will be dominated by UPL. UPL is the world's most, or at least India's most dominant multinational. It will keep gaining market share. All of these are statements which can be questioned. They have a certain probability.
Yeah, and all of these derivatives, it will react wildly to all of these short-term
all of
moves.
this. So we are taking, let's say we decide our horizon, that this is what we are looking out for over a time horizon of 3 years or 5 years or 7 years or whatever. Okay. And in the meantime, volatility. Volatility is not risk. This is risk. Risk is whether this will be 0.
Yeah. 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 I mean, will we be able to achieve that intended target or not is the risk.
Is the risk. So that is the business risk that you are taking.
Yeah.
Okay. That is this divided by okay. So the business risk, so this is a disciplining document. The business risk is discussed separately. The discounted cash flow is therefore summarized and put into a readable, discussable table, where we are looking at the current reality of UPL. We are looking at the target that we are trying to. This is the caterpillar we are buying. This is the butterfly we are trying to imagine.
Okay.
Okay.
Should we also factor in the probability of puts into the calculation?
Oh, yes. No.
With-
It will get very, very complicated. This is the first level document.
Okay.
Let's finish this. After this, from here, this is the stage where you are doing your investing. This is the investing process. Okay, where we are discussing the business risk case of the company. From here, when we get to the trading, we will be talking not about the company or its valuation. We will now be talking about trade picking. Right now, we are doing stock picking.
Yeah.
Okay, so there's a difference between stock picking and trade picking. In all of this, all this 3-year, 5-year exercise is actually irrelevant to the market today. What it will do tomorrow will be to react that Modi has lost the election. Okay, now the market does not care.
Yes.
Whether agrochemical demand is going up or not, or etc. etc. So on a given day, we saw it in the Ukraine war that Ukraine is an agricultural country, UPL is an agricultural company. The stock dropped 40%. Then it took somebody to realize that, oh, the UPL sales to Ukraine is only 1% of their overall global sales, etc., etc. And next thing you know, the stock recovered. So that whole process took 2 months. So these things will keep happening. That is independent of the long-term valuation of it. So you can buy cash shares and go to sleep and not pay attention to this volatility at all. Then you are just behaving like the promoter. You just bought a business and well, the business has done well and you are fine with it. Yeah. But if you want to maximize your returns, then what are you doing? You are taking leverage, which is making money on other people's money. And UPL might go nowhere. Bharti over 10 years did nothing.
Right.
We could theoretically make 150 times our money on a stock that has done nothing. How? We can keep increasing our book size simply because we are recovering the VAR. That's a different concept. We will come to all that. Okay, this potential MTM is actually value at risk.
Yeah.
Okay.
Yeah.
So we will keep introducing all this new jargon as we learn new concepts.
Okay.
And it will get so complicated in the last phase, where now we are separating the intrinsic value of UPL, which is what? 1864 minus 612. This is what we are playing for. So what are we playing for? 1864 minus 612 divided by my time horizon.
Say 5 years or 4 years. Yeah.
So is this, now this is where we beat the algorithms. Algorithms cannot do this. What is the time horizon? Let's say divide by 60. So 20 rupees per month, 21 rupees per month. The market is not giving me, but I'm assuming it.
Right.
You follow? So, so this is how we beat the algorithms. The algorithms do not take a forward view. They take a current view. They cannot look forward.
Okay.
So the algorithms are systematically mispriced. Now, this is theory. We have to make sure that we are always right.
No, exactly. Yeah. I mean, whether this will achieve this internet target in the time span that we are targeting for.
Yeah, we are always right when UPL does what we say it will do. Okay. So we'll get to that where, I mean, we will fool the algorithms with superior option pricing models. Then I will teach you time value trading. Okay. So From the fundamental analysis, we will break down this long-term view, 5-year view of UPL into an intrinsic value that the option market, that an efficient option market should be incorporating, and the time value, which comes from somewhere else, which comes from liquidity, which the market is giving you. So the time value is current reality, and the intrinsic value is what I imagine.
Okay.
Okay. And this is where the market is often systematically inefficient.
Okay.
Okay. So we'll come to those concepts.
Okay.
Right now, I'm just hinting at it. So what is
Okay.
it? This is your bullock cart. This is what you must have. This is your own two legs. Okay. We'll convert this into a very sophisticated document. Okay, where I will ask you very detailed questions and we will build up this document and I'll make you write this document. Then we will incorporate all the learning into a philosophy, the principles on which this operation will run, the policy framework, the code of conduct. Okay. So this will have certain philosophical statements and this will have some actual, intent and so on and so forth. So what is my headline? The doctor is HDFC Bank. Okay. So we are converting this whole thing into a business operation, which dovetails into some other sophisticated business operation, which we are buying at a discount. This is the Berkshire Hathaway model.
Okay.
Okay. So your cost of capital is 6%, but UPL is, the market is offering it to you at a 25% yield. Current earnings, not even future growth. I'm not paying for future growth. And that 25% is meeting my cost of capital. So I'm very happy.
I mean, essentially, this should also bring down the cost of holding, right? So basically, if we take...
You're jumping the gun. You're now going into the risk management actions, the tactics. Okay, right now I'm still at the strategy. Okay, when I am doing that, you're very right. But that's because you've seen me work. Okay, that we will basically bring down. We entered Oro at about 540. We lost money in the calls. We came down to 480. And by the time we exited at 850, 875, the effective cost of the holding had come down to 306. How?
Okay.
Because of the
derivatives.
Yeah, no, the derivatives. So the profits came from where the futures book.
Futures, okay.
But I made money from the puts also.
Okay.
And by a margin over the cost of holding. So where did that go? That was supposed to go to fund the value at risk, fund the MTMs. Right?
Okay. Yeah.
But when there were no MTMs, what is happening? Now I've got a double engine. My futures book is also profitable and my puts are also profitable. And in some cases, even my calls are profitable because I'm doing a range. So I was making money from all ends. That was, what was it doing? It was reducing the cost of my futures book like a stone. It was dropping below any number that you have seen on the chart. It can theoretically go to zero. If it drops below zero, then I can double the book without anybody's money.
Okay, got you.
Okay, so that is where that is the profit, what should I say, loop. That is where the returns go to infinity.
Okay.
Okay, and that's the power of leverage. Basically, what is the power of leverage? Everything. You have earned so much money that you have paid off your, tier 1 capital. Now you are running with zero capital. Now, whatever profit you have tier 1A is getting compounded. If you can keep, now UPL repeats the Aurobindo story, you certainly have infinity return.
Right.
So, if you're making 500% return on a particular story 3 times over, you are running at 130 times your money.
Yeah.
Okay, so never mind the profit pool. We don't have to plan for success. We have to plan for failure.
Right.
Okay, so that this is the discipline. This is the part where the guy who's running the investing operation does not know what is happening to the people sitting in the plane. And the people sitting in the plane don't understand what the hell the guy is doing, what the hell the pilot is doing. So this closes the communication gap between the two.
Okay.
The pilot knows and has communicated correctly with his passengers, and the passengers know that they are in, what they are buying. If we make a mistake, if UPL turns out to be a fraud company, well, we made a mistake. But you know where you made a mistake, and you know what are the right questions to ask.
Okay.
Okay, so this is the planning document, and this will keep increasing. Like look at this box. It's an incomplete box, but we started to calculate the intrinsic value to be attributed to the puts.
Okay.
So this is the intrinsic value calculation box. Then we might add another box over here, which is the time value calculation. So it will get very sophisticated depending on how much you are interested in learning.
Okay.
Okay. And we will discover these things together. For me, the mental models that we follow are, we know what we are doing. And that is embedded in this philosophy document. All this.
Yeah. Yeah.
So this will be a co-discovered philosophy. It's not something I'm talking down to you.
Yeah, that's correct.
Okay. It is also not what I'm doing for myself. I might be doing very adventurous things. Okay. But I'm not willing to do it for you, let's say. For example, we have not talked about buying options yet. Okay, because I keep saying that never try to forecast the market. As a defensive strategy, this is not something I will ever want to do for other people. I might do it for myself. But I am not going to try to forecast the market for you. There's a particular category, a hat which you must wear. You're a banker, or you're a hedger, or you're an arbitrator. You are not a speculator.
Yeah.
Forecasting the market is what I call speculation, because you have no control over the probability of success in the short run. In the long run, we are doing that exercise. So the longer the run, the more accurate, the more probable that I'm going to be right.
Okay.
So I'm very confident that this 1800 will be seen. Maybe not over 3 years, it might take 5 years, it might at worst might take 7 years, but we will get this number. Now, what do I have to do? The cost of carrying your rollover cost, this cost, over this period must be recovered with a huge margin on top, which is what you saw us do in Aurobindo. Okay, that when Aurobindo was tanking, we were saying that, okay, this has a bottom, some bottom. Now, whenever that bottom, we assume it stays over there. Now I have to fund the MTM. Right. With a certain rollover cost. As long as I'm making money over the rollover cost, my MTM is reducing every month.
Okay.
So you can't kill me. If Aurobindo stocks at 200 rupees, my cost will be down to 200 rupees within 6 months.
Okay. I mean, either one of them should be correct, right? Either the futures or the MTM.
And as we saw with Aurobindo, when the rubber band gets pulled to a level where the valuations, you're getting an 18% ROCE company at 0.8 times book value with no debt, with the pharma cycle around the corner. I mean, how long can this story be hidden? And we saw what happened. Okay, so the fundamental story, you already know how I built my fundamental stories. Those fundamental stories are now going to get incorporated into your own engine. And I'm telling you the policy framework, that the current yield, the current valuations of UPL should give me a return that is at a significant premium to my cost of capital.
Right.
The valuation migration. See, we are coming in at 4 times EBITDA.
Yeah.
We are imagining 7, 8. UPL started at 15. So, I mean, whatever number you want to take. FMC is at 12. Okay. So, who knows? We just saw what happened to FMC.
Right.
Now, whenever the market decides that, hey, that industry is different, FMC, Adama, UPL are different from the rest of the agrochemical industry. And now there is going to be parity. Whenever there is fashion or whatever, the sector becomes everybody's favorite. And suddenly you get this kind of valuation.
Right.
That's what we are arbitraging. Can I control all that? I can't control all.
Right.
Okay, so we discuss the current situation, which is a statement of fact. We discuss our target, which is the butterfly that we are buying, and the probability attached to it. So that doesn't have to be a mathematical number. You will find over time that it is basically an opinion all the time. What is the likelihood that we are going to get 12 times, 15 times, whatever? But whatever we are discussing should be seen in a number. And then from here, I will start calculating, okay, if you believe that, then how do you price your puts? It should be embedded in between what you're thinking, should be embedded in what you're doing.
Right.
Okay. And then, we'll take all that and we will develop our own option pricing methodology, which is not the stupid Black-Scholes or Monte Carlo, that, all these theoretical things that don't work, but which are taught in the academic world. And the algos also work on that. Okay. So this is the entire, comprehensive process. Now, as we will take multiple visits and then keep cleaning this up, as long as this document is maintained with discipline, we are unlikely to have any, trouble. We are unlikely to see any sudden risk. Obviously, the market blowout, a COVID bottom, or a global financial crisis will happen. It will happen again. Also, we have to survive that. So, but that will be a matter of inconvenience for us. It will not be a matter of death for us if we have planned for it.
Okay. Yeah.
Okay, just like we survived UPL's, current decline pretty well. And as you can, anyway, let's see how it moves forward. Right now, I think it's playing according to the plan. Okay, so the last thing that is not there in this document is the trading strategy. I haven't developed it yet. That we will develop together, and you will see that it will be a highly individualized strategy based on the investing view that we have of the underlying company. And so if we change this to Infosys, all of this is going to change.
Right.
Because in Infosys, I am not thinking of it as a perpetual multi-bagger. I am not thinking of it. It's what we call it, a stalwart. It doesn't have much of a downside, but it doesn't have much of an upside. But UPL, we are looking at a caterpillar that could turn into a butterfly. We think, that's why I keep saying it's a never sell.
Right.
Okay, so as long as you're getting it cheap, this is a company with unlimited runway or whatever, so you've got that hypothesis.
Okay.
Okay, so this introduction is what I'm wanting to take everybody through, and it becomes a communication document.
Sure.
Okay.
Sure, I think this is very detailed, sir. Yeah.
So let's just launch into the exercise and create a monthly review plan with this.
Yep. Sure.
Right then. See you.
Thank you, sir. Thanks a lot for your time.
Any questions that are coming to you immediately?
No, I think I'll need to fill out this document in its
Yeah.
entirety
So I'll-
and then
I'll send
see what the metrics will look like, right?
Okay.
So then, yeah,
So I'll send it to you.
sure.
Okay.
Thank you, sir.
Good night. Good night.
Good night. Take care. Bye.